You're listening to The Money Hour with your host, Tina Mitchell, and co-host, Keelan Harvey on Alternative Talk, AM 1150. Now, back to the show with local mortgage experts, Tina Mitchell and Keelan Harvey.
You are listening to The Money Hour on 1150 AM KKNW, the Saturday, April 24th show. You can also listen to our podcast or our Facebook premiere show. I am your host, Tina Mitchell.
And I'm your co-host, Keelan Harvey.
We bring into studio each week the best of the best experts in our local market, everything regarding your money. We are here to help you in today's economy. And now in studio, we have John Trahms of Insurance Foundations. Set up your own pension right here on 1150 AM KKNW. John, welcome to the show.
Thanks for having me.
Yeah.
John, we scratched the surface a little bit, but can you dive in a little bit deeper on what specifically you specialize in?
I always tell people I specialize in wealth building and retirement strategies using life insurance products. So a lot of people don't know that you can use life insurance as an investment tool, and it does have to be set up right. You can't just go and get any generic life policy. It does take some specialization. But if you set it up right, you can actually use life insurance to build wealth for yourself that you can use. And it's all tax-free. It's another way of generating tax-free income for your retirement. The other thing that I specialize in is setting up these kind of personal pension retirement things using annuities and helping people in retirement move over their 401ks and other IRAs that they have and setting up a stream of income that they can't outlive. So it's just kind of specializing in helping them retire well.
Helping retire well. That is a great tagline, John. So John, let's talk about pensions and why you don't hear a lot of people talking about them.
Well, pensions, I think I'm one of the few people that still has a pension. Years ago, I was working for the laborers union in Minnesota when I was young, and they had a pension program, so I learned about those. But I think somewhere back in the 80s and 90s when investments started ballooning and people could make a lot of money in the stock market, they were looking at their pensions and thinking, how could we make more money? And so they transitioned to investing directly in the stock market. And for a lot of years, it made a lot of money, and it's been a really great thing. But a pension it's basically a guarantee that no matter how long you live, you will always get the same amount of money. It's not based on how much you put in. I mean, initially it is. But even if the money goes away, you still keep on getting paid. And as people keep living longer and longer today, I think that's something that people are going to really want to look back into is stretching their dollars longer so that they can have a guaranteed income without worrying about whether their investments disappeared because of the stock market.
Yeah, and you talked about very few pensions out there. Keelan and I know being in the mortgage industry, you very rarely see people using pension income to qualify or have pensions coming. Now, fortunately, my husband was a union superintendent in construction, so he has a pension, which is really nice. But yeah, very few out there.
Yeah, you hit it on the head, Tina. Even Boeing got rid of their pensions. So, I mean, it's just too expensive for companies. People live way longer. They can't afford them. They can't offer. They transition to some 401k plan of some nature. But so that leads me to my next question, John. Considering not many companies offer them, how do you set one up?
Well, life insurance companies have been offering annuities for years, but they're set up so that if you have a lump sum of money that you have like in a 401k and you're looking to retire, you can move that over into an annuity contract with a life insurance company. And they're set up so that you can either start drawing the money off right away. You can wait a couple of years. You can have it grow and invest it and see if it'll turn into more money. And you can activate that income later. And so there's a lot of different options in that, but it's really simple. You just move the money into an annuity and then start taking the distributions whenever you need to.
So, John, when you take a peek online, there's a lot of people that really don't like annuities. Why is that?
Okay, so when I first got started in the industry, I wanted to make sure I wasn't getting people into something that was bad. And so I did a lot of my own research. And there is a lot of negativity online about annuities, which is kind of funny to me. I think a lot of it actually comes from back in the 90s. There's been a lot of legal changes and a lot of federal oversight that has happened since the 90s and has regulated the insurance industry to a point where it's really, really difficult to actually go through and just sell somebody an annuity or help them get into an annuity. I have to go through a whole long list of documents and explain how this is good for them. And, they have to understand the whole process. You can't just go and just throw something at somebody and say, okay, this is good, sign here on the dotted line. They actually have to understand it now. And I think back in the 90s, those regulations weren't in place. And I think a lot of people got into some bad products. So yeah, I think that's probably where a lot of the negativity comes
And isn't
from.
that crazy? You go all the way back to the 90s, and the 90s are still haunting something that's an awesome product now. Crazy.
Yeah, we run into. Oh, go ahead. Sorry, John.
Oh, I was just going to say, there's so many changes that have happened. I mean, Chandler talked about even the recent changes in the tax law and tax codes. There have been so many changes with the Fed since the 90s. We've seen the Patriot Act and all those other things that affected finances in a totally different way. And yeah, the holdover from the 90s, I think, is still in people's minds, even though so much has changed.
Yeah, we run into that still with adjustable rate mortgages. Back before 2008, there's these crazy products. People weren't educated on them. And you mentioned ARM. To some people, it's like a swear word when you're like, no, they're amortized for 30 years. They're set for a certain amount of time. You have to really educate them to realize. And a lot of people won. They're not winning now, but a lot of people won on ARMs in the years of the past where rates were. So that education is key because it's not the same world as it used to be. John, tell us more about how a annuity can help normal people in retirement.
Well, I'll just give you a case example. I had just helped the customer last year, and he only had about $150,000 in his retirement account, and he wanted about $10,000 a year. Well, it's pretty simple to do the math on that. If you take out $10,000 a year and $150,000, it lasts for 15 years. He's really healthy. So the chance of him living longer than 15 years, I mean, that he's going to outlive his money. And I was able to find him an annuity that was able to pay him about $10,000 a year. And regardless of how long he lives, he can live another 30 years if he wants to, if he can. And he's still going to get $10,000 a year. It's a way to stretch money. And like I said, they're safe investments. They're invested in the bond market. They're not tied into the stock market, so you can't lose money. And it's a way to just really take what money you have and make sure it's there no matter how long you live.
And I will say, John, that my mother-in-law, we have her on one, and it's, going through and looking at, the whole thing and really strategizing what's best for her. That was a really great option. So I'm so glad that you're specializing this and getting the word out there. So when is the best time to set up a personal pension type annuity?
Really, kind of any time, but the best time is actually right when you're transitioning out of the workforce. So when you're getting ready to retire or you are retired, and you get access to your 401k or your retirement account with your company, that's really the best time to set it up and start, because you have options then. You may or may not need the income right away. If you don't need it right away, you can delay drawing that out and hopefully see that grow more. And, it's really just when you retire, it's the best time. Then look into it.
A lot of people too, John, it's crazy. They leave their money in a company they retired in, and it's a blackout. They don't even know what's happening with their money. It's just sitting there. And I can't tell you how many stories when I was in the business of people just having money sitting there and they don't have any control over it whatsoever. Get that money out. Even old ones, it's like from 5 companies ago, and they have all this money spread out over. If you're retiring, get that money out and talk to John and figure out the best way to go about it at that point, because you have zero control over what that money's doing in some instances. So, John, I know some of our listeners probably have the question of, what if I run into an emergency and can I get my money out? Is that possible?
It is. Most of the contracts now have about 10% that you can access every year without any burdens or anything, and no fees involved in that. If you've had the annuity for generally over 10 years, most of them are only 10-year contracts. And so after 10 years, you can access all of the money that you want. There are even provisions in there in case you have an illness, you're diagnosed with a chronic illness, or you can access most of the money without any penalties. Again, the penalties really aren't that big, and so it's really only a 10-year or 7-year contract. After that point, it's all your money and you can do what you want.
Well, and John, if you plan correctly, you should have 3 to 6 months of your monthly savings in another account anyways, correct? Yeah. So this is money correct. You should not be touching anyways if you plan correctly.
Great shout out, Keelan. So John, how safe is your money and what kind of return are you telling your clients that they might expect?
Well, I keep on telling customers that insurance companies are some of the most liquid companies around. They have a lot of assets in the hundreds of billions of dollars. And a lot of these companies have been around for quite a long time. So as far as I can tell, doing all the research I could do, they're about the safest investment you could possibly do, arguably even safer than banks, just because of how much liquid capital they have. As for return, you can get that. Last year when things were really, or 2 years ago when things were amazingly great, some people were seeing returns of about 15% in their annuities. That's rare. They are designed to give between a 5 and a 7% return. So I think if you plan on having about a 5 to 7% return over the time that you've got it, that's probably really reasonable.
Well, and another question I'm sure people have, and there are some fees involved with certain plans and such. Are there any hidden fees? And how much does it cost to get something like this set up, John?
There really aren't any hidden fees. The insurance companies, one of the things I love about working with insurance companies is because of all of the regulation and the oversight, they are upfront on like page 2 of all the fees and everything that's involved. There's no hidden fees. There really is no cost actually to set one up. It's free. I get paid even by the insurance company, so I don't even get paid by the client. It doesn't cost them anything. And the only fees that are really involved is if you decide you want to cancel the contract and take all of your money back out, because they didn't charge anything upfront, then they want to be able to recoup some of the cost of paying all of their employees, everything. So there is a fee if you decide to cancel everything, within the first couple of years.
Kind of sounds like mortgage, no hidden fees. However, there is cost associated to a mortgage. They don't have to pay for us, but there's cost. All right. So as we wrap up our time, we've got less than a minute here. What a great service and specialization that you're offering your clients. How else are you helping people?
Mostly with the life insurance side too. I think that's another part that people don't really spend a lot of time looking into. Helping people build wealth for themselves and even their children. I just ran some things to help out the customers with very young children. Try to build a future for them. So
wonderful. John, thank you so much for joining us on our virtual studio.
Thanks for having me.